Hello, I am Ed Butowski, the host of Wealth Transparency. Thank you for joining us today. As we do every single week, we take headlines that don't necessarily make it to the front pages of every single newspaper, and we talk about what people should do as a result of those headlines with their portfolio. I'm honored today to have Michelle Connell, who is the Chief Investment Officer and CEO of Portia Capital Management. We have Lex Nikpour, who is with Ethos Financial Group out of King of Prussia, Pennsylvania, and Andrew Tang, who is the Chief Information Officer for Turner Financial Group. Thanks for all three of you being here today. I want to start right off and encourage everybody who's watching this to reach out to one of these individuals if they can help you with your financial portfolio. To start off with, the market valuation is becoming a real concern of mine. I'm having clients call me and they're having a lot of fear of missing out, a lot of FOMO. And I keep encouraging them to look at the valuation of the market because that's what's going to really dictate the direction of the market. Michelle, how do you feel about the valuation of the stock market right now?
We can always say that things are highly valued, right? If we just followed that particular thesis, we would miss out. Yes, things have run up, especially in the tech area. But when you've had earnings growth as high as we have, that's been reported most recently, close to 30%. And for 2026, for the whole year, you're looking at about 25% earnings growth. And you compare that to a forward PE on the S&P of 22, not overly expensive. Yes, it's gotten more expensive, but not so expensive that you don't want to buy anything. I think you just have to be more selective than ever, especially when you're dealing with a small number of stocks that have gone parabolic.
So next, if we have a PE of 25, what should we be looking at for earnings growth?
Well, I mean, honestly, I think Michelle hit the nail on the head, right? Like earnings growth has been robust, particularly in the sector of tech. And we started to see, but that's because the demand side is so high there, right? And we're seeing that funneling in, and there's support there, and I mean it's really going to get tested. We talk this time next week. You have one of the largest anticipated IPOs in the history of markets, so it's really going to test a lot of that because there's exuberance there, but there's this expectation that all of these companies are in support of this momentum moving forward with artificial intelligence, everything shifting all the way up the value chain and across the board, and industries making that adoption. So, I mean, I don't want to say it's impossible to guess that, but this is sort of, I think, where the art comes into play versus necessarily a hard number when it comes to valuing what the future earning potential could be, because really it depends who you ask. Just like you ask someone, what would you do with SpaceX shares when they're tradable? And some people say, I'm going to hold until we go to Mars. And you have other people saying, I'm going to take advantage of that and be on the other side of it. So I think it's difficult.
Yeah, what is your thoughts on the valuation of the market? And then please lead us into your SpaceX.
Yeah, this is absolutely an exciting time for everyone. The most important fact is that the AI bubble thesis has been debunked with the earnings announcements from most of the companies across the board. And it's not just about tech companies because of the multiple layers that this AI infrastructure build is lifting. You have the electrical system, you have industrial system, you have the energy sector. All these are being lifted in inclusive of the chip sector as well. And so it is really right now, people can say that, well, we have time for this bubble to build, and it's true. And we have earnings expansion at the same time is a combination of maximizing efficiency, enhanced productivity, a dollar saved plus the dollar earned, and then we're also going boldly into a new frontiers, of the marketplace. So because of the earnings growth and improvement, the S&P valuation actually has come down. The forward PE is only trading about 21x right now. Before, it was astronomical. And if you can recall, the tech sector back in the 1999s, the PE was like somewhere around 80 to 90. Okay, that's how ridiculous it is. So the marketplace this year, it's really occupied by, June 12th, which is the debut of SpaceX IPO. And I think this marks the beginning of, getting proof to the pudding where AI becomes real world and where money actually gets into and get to work in real space. And this is where I think a lot of investors, especially with this IPO, many retail investors are able to get involved. And so this is exciting.
So we were talking before we went on about valuation of SpaceX, and you said that there's one firm that was shorting it,
Yeah.
and that's Jeffries.
Yeah, Jeffries decidedly to short SpaceX, and it's confirmed by Bloomberg. And it just came across today after the fact that Jeffries was left out of the IPO participation. So I don't have all the details as to why they're shorting it and how much are they shorting it, but it is a very dangerous game. It's almost like, all the naysayers out there that are shorting Tesla. And if I'm correct, most of them has lost money, including the big wigs out there with institutions. So it is still a dangerous game, in my opinion, to short SpaceX because it is so widely anticipated. So far, SpaceX is 4 times oversubscribed. They just put a value out there yesterday, $135 per share for IPO at 1.77 trillion valuation. It comes in right in between, not too high, not too low, but most likely it is going to pop because it is going to be almost immediately be included into the indices.
It's hard to know who doesn't own SpaceX. I mean, none of my clients own SpaceX, but it seems like SpaceX has been around for so long you could buy the shares in the secondary market from insiders at SpaceX. Alex, what is your firm's position?
Yeah, we've owned quite a bit of SpaceX, going back probably almost 8 years now. Clients of mine have owned it for quite a bit. We've bought more along the way. Been a little less excited to go grab more in the last 4 months just because of the extremes of the valuation. Andrew's right. There's so much exuberance here that really you could see, excuse the corny language here, but you could see SpaceX take off. It's interesting because Morningstar came out saying that SpaceX, they had it pegged at a value of about $785 billion. That's about $1 trillion short of what the anticipated IPO value is supposed to be. A lot of room there for some to be right or wrong, but the demand side of this it's truly unprecedented. It will be very interesting, and as Andrew was leading to at the end of his comments, is going to be what's going to be really interesting to watch is how you have this company that all of a sudden, from a market cap perspective, needs to be allocated to all these passive investing indices, right? And it's going to have to make its way onto the holding the portfolios of mutual funds across the board and ETFs across the board, trading intraday as well. So there's been a few studies on exactly how that's going to play out. Some folks have come in to say exactly how that's going to work. I still think the precipitation of that across the market is somewhat unknown. I mean, you have to play a lot of scenarios to that. So we'll see, but it's going to need quite a bit of liquidity, and there's going to be a lot of excitement. And I think clients just need to be prepared. This really harkens back to a lot of what we as advisors talk about in understanding what your risk capacity is, not necessarily tolerance. And if you have the capacity to take on this risk without it derailing all of the other things that you are looking to accomplish in your financial life, then enjoy it. But if you're levered to the hilt and you're saying, I'm going for it because you have FOMO from not buying Micron, 6 months ago, I think you're going to find yourself in a world of hurt.
Michelle, you're kind of an old school evaluator of stocks. And if you were to take a strong look at SpaceX, how can you justify a $1.7 trillion valuation?
I can't at this point. I mean, I own it in some private equity funds, and they've held it for a while. I know firms like I think it's Stepstone owns it in their private venture fund, which is an interval fund, and it's a heavy percentage of it. You have other ETFs that have own it for a while. So I think I wouldn't be chasing it here. When I looked at this today, I thought this was interesting. It's selling, the range that they're quoting would be equivalent of 95 times to 105 times sales. And that you compare that to aerospace. I know it's not aerospace, and aerospace is not Elon, but aerospace rather, usually trades at 5 to 20 times sales. Now, this is where it gets interesting. At this valuation, SpaceX combined would be 6% of GDP. Compare that to Microsoft, which is 0.5% of GDP. Now, I think that says a lot right there, doesn't it? I mean,
Yeah.
That's a lot of money for a company that has a lot of risk associated with it. So I think if you frame it like that to a client, it says, don't chase.
Starlink is a big part of SpaceX. And I've been seeing on TikTok this little device that I can do Wi-Fi anywhere. And it just makes me wonder how Starlink compares to this little device that is $30 for me to sign on to. This is way above my knowledge base. I just look at pure valuations like you, Michelle, and just think, how in the world can you support and justify this? But
and we'll probably regret it, Ed.
Yeah, I have to add to it that this is absolutely not a trade. This is an investment for long term. And it is really reserved for those that are accredited or actually who know and understand the risk. But in my true belief is that I believe people are buying here is not buying it for the valuation now. I mean, Starlink is making roughly about $50 billion a year, but you're buying into Space AI, and Space AI is an amazing prepay model. You can see by and confirmed by the Anthropic deal that is already coming into place. Okay, can you imagine that? It's a prepay deal. Companies are paying prepay for the tokens that Space AI are promising. You don't have to deliver it. They didn't even tell you when it's going to be delivered. But that prepay model is an amazing deal. Then you have to look at what Starship program and the government contract and defense contract is looking to bring to this company. And then there's potential integration with XAI. Again, moon base that is going to be developed, scientific experiment that is, that we're able to conduct. And so it sounds like science fiction, but again, we are looking at the valuation at 1.77 trillion now at the present day value. In my opinion, it's going to create new wealth because we're boldly going where no one has gone before. Okay, so this is a new frontier. Absolutely. So in the present time, absolutely. It doesn't make sense, but we have to think much, way ahead of what's to come. And this is absolutely in the new wealth developed, area.
Well, that kind of parlays into home prices in San Francisco because you're seeing, valuations at levels that don't make any sense. I know a lot of young people that live in San Francisco chasing their crypto dream or their AI dream, and they're paying like $5,000 a month for a tiny shoebox of a place. Who wants to take the valuation of the house prices and the AI wealth there?
Happy to start.
Yeah, go ahead, Michelle.
It's interesting when you look at that, not just San Francisco, but that entire area. I mean, the median home now is $2.1 or $2.2 million in San Francisco. A condo is at 1.4. I looked at what made me interested is when I started to see home prices in Tahoe, because that's where a lot of people in Northern California go to have vacations during the summer. There was an article in the Wall Street Journal that it was a family that had bought a home on the shore, North Shore of Tahoe, I think 15 years ago, $1 million. Some guy came in, AI money, offered them 18 million. And they said, this has been in our family for generations. We've had these, all our memories here, but we can't turn down that money. So that's going to help us fund our grandchildren's education, etc. But you look at that, everybody else is priced out. They don't have a chance. They don't have a chance. And that's the sad part right there. And so does that mean that San Francisco goes back to an area or Northern California with only the very rich and now only the billionaires can afford to live there. It's not good.
It sounds like it. I mean, we have recently announced that the Dallas Stars and the Dallas Mavericks are moving out of downtown, moving out towards where we live. And we question what that's going to do to real estate values. We don't know if it's going to increase them or decrease them. But, we all live in the public markets, and there's so much money made in the private real estate market. It's really scary. Lex, you live in a suburb of Philadelphia. I'm sure that the housing prices have soared there as well.
Yeah, I mean, it's the perfect mix of health, education, and meds, and so you it becomes a very desirable area. Plus, close to one of the largest metropolises in the country. So highly sought after for certain. And home prices, even in the Great Financial Crisis, I mean, they really didn't contract all that much. But I look at this where really as the buyer, I think the individual has to make the decision for themselves as to what's most important to them. Because if it's important to them to be in San Francisco and they think that's the hub and being in and around it is going to lead them to opportunities that they wouldn't otherwise be exposed to, that's their decision to make. I would argue there's more hubs of technology and innovation across the country nowadays than there's ever been. And there's an incredible willingness for people to be able to fly out to those areas. Look at Austin. Austin's a really interesting, I mean, listen, I understand home values have gone insane, but that's because of what's really taken place over the last 15 years, right? Prior to that, it was a far more affordable place to get to. And yeah, you had Dell, that was the first mover from a tech space really down there. And not too far away, you had Texas Instrument as well. But it was this sleepy sort of area that had tech innovation. And everyone from California basically said, I'm fed up with not only the taxes, but the strings attached to those as well. And they said, I'd rather go to a more favorable place. And now all of a sudden you saw the boom in Austin. And home values have ripped in Austin. But then you see the expansion south into San Antonio and some other areas. But then you also have tech hubs in North Carolina, where people are saying, in the Raleigh-Durham area, there's a little bit. In Ohio, you're starting to see it. So, and even middle of the country, Tulsa, with its proximities to Fayetteville, Arkansas, I mean, you start to see these little pockets pop up where, because of the innovation, I think it breathes a lot of life into geographies across the country that otherwise didn't have it. And lastly, I think it comes down to, I'm raising my hand here too, because I fall prey to this, right? Of sort of being where the people are and all of that. But I think people need to be discerning about what's most important. And now more than ever, you can be in DC is a great one, right? In the greater DC area, there's a lot of tech in DC. So I think people these come in waves. It was a couple years ago where San Francisco home prices had absolutely, I mean, cratered is probably aggressive, but cratered relative to where they were. So we're just seeing the buying back up of that. And it seems to be just a standard sort of market action, but it's a beautiful place to be.
Sort of like the wave that we saw with the internet. Now we're seeing that wave with AI, and we're seeing the crypto wave falling on its face. But Andrew, you live in Jersey. I can't imagine any house.
No, Jersey, it's not as crazy as San Francisco, and I think I have some stats to show you that's how crazy San Francisco has been. And I think this level of exuberance won't last too long. There's going to be some type of a correction, but definitely a bubble building. The luxury home prices in San Francisco has roughly gone up about 15% year over year. Don't forget, the national average is only supposed to go up 1 to 2%. So they're up 15%. And then the city's medium home prices is at, as Michelle mentioned, it's about 2.15 million, right? And this is as of March. This is not, too far away from us. And it's up about 18% from last year. And then you have home prices that are about $5 million, increase 83% year over year. And then the pending luxury home sales in San Francisco rose about 48%. And in addition to that, home prices above $10 million are reported up about 60% year over year. So these levels of exuberance, in our view, it's it's creating a huge divide among classes of, income. It is a problem, but at the same time, it's good for the city. The cities are collecting more taxes in real estate, and hopefully they will use those money, towards some goods, for overall for all the people. But again, this level of growth is not going to last too long. I mean, we just got to be careful of that and watch it very carefully. I always have thought that because home prices in general has been increasing so much that we are due for a correction, but it's because of the amount of people, so many people have enough money to keep this sector steady. They're not selling. I mean, look at all the vacancies out there with all the stores. So if you say commercial real estate going to go bust, no, they're just sitting tight. And so because of the fact that there's so much money out there that is enabling this sector to stay steady, I don't think we're going to have a correction in the real estate area anytime soon.
Let's talk about finally an area that we all know very well where there is going to be a correction, and that is in the oil markets and in the bond market. Yields continue to rise and oil prices continue to rise. So Lex, what is your view on both of them?
Until things are resolved, and that's a insert ellipses at the end of resolved, because the lag effects from the disruption we've had here over the last 10 weeks is really challenging. And for anyone who was watching Bloomberg and reading, what was coming out by the heads of a lot of these energy companies, whether it was Chevron or Exxon, I mean, they understand what's happening here on the supply side. They also understand where we're going because of the reserves. And I mean, you hit bottom on reserves, you see the price of oil rip. I mean, 200 is not an unforeseen number to hit on the price of barrel per oil. And I think the trickle down of that would catch a lot of attention. Could be a bit of an equalizer to the socioeconomic demand here, a little bit, not a lot, but I don't mean to say I don't know, but it's a precarious position to be in, because what if this drags out for longer, which it seems to be doing? And it's not like the midterms are really scaring this administration too much. You would think it would, and they'd be coming to some sort of a resolution. And I think the more it drags on, I mean, you could see some huge dislocation in the bond market. You could see that will obviously trickle down into the equity markets, even though there's all of this expectation on the right side of this with growth and long-term trends on AI. But it's not to say that this extension of oil at extreme prices wouldn't have a massive effect. And you'd see the same thing in the bond market. I mean, that sell-off, that'll catch a lot of people's attention. And you know what? For the majority of investors, today's investors, I would say, retail investors, really haven't experienced a market like that. Everything we've had up until this point I can point the finger at my generation, which are, late 30s, mid 40s, highly consuming, earning money, starting to get into prime earning years and earning money. But we've experienced coming out of school in the great financial crisis, but we're getting jobs at that time. And then really the biggest pullback, 15 was a bummer because no one made any money, but really it was COVID. And then you have Liberation Day last year, but these incredible V-shaped recoveries where you're still working, you're still plowing money in as best as you can. I think what we would see here is a prolonged negative effect on the markets that would sit for a little bit, but it's anyone's guess.
Michelle, I keep referencing that you and I have been at this the longest, but
Thanks, Ed. Appreciate that.
Remember a time where there was this blank sheet of paper and you could put as many negatives for the future as you can positives for the future.
Okay, so I'm going to add on to what Lex said, and it came from a Bloomberg interview where you had the CEO of Chevron say he's concerned June and July will be critical because of the amount of fuel that's used by people during the summer months. But he said obviously he's biased, right? So because he's trying to make sure that his company does well. But he sees the excess reserves coming down, and potentially that will lead to economies slowing on a global basis. Now, this past week, Canada tipped into recession territory. And that's concerning, because if you look at the countries outside of the U.S., they're being affected more than we are by the global issues. Alone on food in Canada, they're paying an additional $500 to $600 a month. That's not just the fuel. Yeah, yeah. And so look at that, and that can go over to the UK, and then it can go over to the EU, and those countries are already not very happy with us. So if you're going to go and have a vacation overseas, do it now, because Americans are not going to be well thought of.
But and sorry, because Andrew's up next year. But it just made me think of something, Michelle. Yesterday, I had a tree guy over to take a look at a few things and was asking him about business, and he said to me, he goes, "You wouldn't believe the cost. We've spent an extra $10,000 on fuel in the last 2 months." And he goes, and I can't pass that on that on.
Yeah.
Because they'll just say no and move on to someone else who will do the job for cheaper. Imagine that his business margin shrinks considerably,
And he's small business.
He's a small business. Yeah.
Yeah.
That's exactly right.
Report on the local news about $46,000 more for a one-way trip from Dallas to London. That's how much more the gasoline costs, or the kerosene, whatever they fill up. $46,000 more. So they have to make that up somehow, either through baggage or selling seats. But a lot of it they haven't hedged properly, so they're going to be losing money. So airline stocks should probably be something short. Which then brings me to, in conclusion, as we do every week, based on these conversations, which stocks would you go long right now, and which stocks would you short? Andrew?
Wow. Okay. We'll jump right into it. I think right now we have to evaluate everything that's going on. There's so many to choose from. I think right now, what I would really focus is Tesla. It's obviously SpaceX, and eventually SpaceX and Tesla will merge, right? So if I look at the valuation, depending on how post-IPO SpaceX trades, I think there's a real good opportunity here to get into Tesla because of the eventual merger. So for that reason, I think Tesla is still grossly undervalued as a real-world AI and robotics company. On top of that, you add in the autonomous tech, robotaxis, energy, and I think the company is grossly undervalued as compared to the eventual merger with SpaceX.
Even with it selling at a forward PE of 400?
Of course, because you're looking at the current value of what they're bringing in, but not what the future could bring. So, for example, if a company must complete 10 steps to get to that future valuation or future revenue flow, then how many steps out of the 10 has the company completed? And that's how you do it. Otherwise, how can you ever valuate a biotech company that is designed to never make money? The only value is their IP. So how do you value that? So we need to put those think hats, the way they value companies, not just from what is the net revenue that they're collecting now, but what is their potential upside could bring, and how far along are they?
Lex, what stocks would you go long or go short?
You're going to call me boring here, and I know me being a young person, maybe I should be a little bit more in Andrew's camp here, but I think hard for me to just totally excuse some of my political science upbringing here, but I think I like Home Depot. I think with home prices being what they are, people are going to stay put a little bit more. They're going to be working on their homes. Yeah, you have to ask about the consumer a little bit and home building for sure. But I think, I like a company like that. Good, strong cash flow, paying a dividend, good price right now. We've had compression over the last, since September. So I like the valuation there right now and the play on that. If I wanted to be controversial and say short, I might say SpaceX, but I'm not in that camp. On the short side, I that's a tough bet. I don't really play on that side of it because I'm an optimist here and I believe in the market long term. So I think SpaceX, I think to Andrew's point though, you're buying and owning SpaceX because you believe in the boundless opportunity in the future. You're not buying it to make a profit.
Okay. Michelle, you're up.
Well, first off, in terms of shorting, you have to have a total different mindset to short and make money. I know this because my firm in Chicago, we had a long short fund and it never did well. And that's a really a difficult game and you might get caught. So I don't do it. So instead I make money on tech because I like tech because I'm old, Ed, and I've been doing it a long time. Okay. All right.
Okay.
But it has served me well. All right. Starting out as a semiconductor analyst in 1998. All right. So I like Broadcom. It's pulled back here today a lot, but it looks really interesting based on the old fashioned PE going forward. It still looks cheap. Dell looks interesting. It pulled back. There's still a lot of build out here. I do own Anthropic. I think it's going to be interesting to see how that prices out. I will say, I think it's interesting that they kind of got into the line second for their IPO versus OpenAI because they're smart enough to know there's only so much capital out there and you can only have so many $1 trillion or almost $1 trillion companies. So they're like, we're up next, we're filing. And so they beat OpenAI to the punch.
Okay. Well, for those of you watching, please share this with everybody you know. We're trying to build up our following. And if you have any questions and want to reach out to Michelle Connell at Portia Asset Management in Fort Worth, Lex Nikpour at Ethos Financial Group in King of Prussia, Pennsylvania, and Andrew Tang with Turner Financial Group. Thank you very much for being here and look forward to talking to you next week.
Thanks, Ed.